Hey, good morning, everyone. Welcome to our Getting Started with Options webcast. Today, I'm Connie Hill. Happy that you joined me here today. Cameron May, he'll be back later this week, I believe, and back with Getting Started with Options, but I'm happy to be here with him today. Now, what if a stock that you already own in your portfolio could generate some additional income for you without having to buy more shares? Would that be interesting to you? Well, that's the kind of strategy that we're going to be talking about today for stocks that possibly you already own in your portfolio. Now, I am joined in the chat by Scott Thompson. You guys know Scott. He's going to be helping me out here today. In fact, Scott taught a webcast yesterday. I might show you where that's located if you want to check it out. In any case, I hope you're following me on X. I'm Connie Hill CS, and I'll post educational content throughout the day. Many times it has something to do with charts or things that I'm noticing in the market. So it's nice to be able to just follow along and kind of pick up some nuggets along the way. Let's go through our disclosures and we'll talk about the strategy we're going to talk about today, which is covered calls. All right. Options carry a high level of risk and are not suitable for all investors. This covered call strategy that we're going to talk about today can limit the upside potential for the underlying stock position, as the stock would likely be called away in the event of a substantial stock price increase. We'll talk about that. We're going to be using the Paper Money software application. It's for educational purposes. It's a great tool to practice these strategies that you're learning. What we talk about today should be considered informational and educational. Don't consider it a recommendation. Investing involves risk, including the loss of principal. All right, today we're going to talk about this covered call strategy, what it is, why you might consider using it, why it might be a good strategy. And we're going to walk through the basics, what you need to think about as you're doing a covered call. We're going to look at a couple of examples here today. We're going to look at a couple of examples that you might consider, but I'm also going to possibly show you some examples that might not be good for a covered call. And then we'll talk about where you can find additional resources for this particular strategy. Now, as you have questions, go ahead, type those into the chat. I'll try to keep my eye on the chat, but Scott will help me out there as well, fielding some of the questions that I can't quite get to. Now, if you're listening to this on the recording, I know there's lots of you that do that. When you have a question, type yours into the comments of YouTube, because we go back and review those comments throughout the week so you can get your question answered really quickly as well. All right, let's talk about what does it mean to sell a covered call. I'm going to say that this might be a strategy that you might be introduced to fairly early in your options education, this idea of just selling a call. So what does that really mean? When you sell a call, you are indicating that you're willing to sell 100 shares of your stock to somebody else in a particular scenario. Okay, so you have to have 100 shares of stock in order to take advantage of this particular strategy. So that's why it might be stocks you already hold in your portfolio and you want to generate some additional income from selling a call, and you're not buying more stock to help with that revenue. We're going to be selling that call. Now, when we do, we have an obligation to potentially sell our stock for whatever the strike price is. Okay. When we do that, we get to collect a premium for that. For that potential obligation, we're going to get paid. And so some people will do this strategy simply to try to generate a little bit of income in certain circumstances. So you're looking to generate that premium. You want to have an idea of when you might want to get out. And when a time is that you might get out is maybe when the stock appreciates to near that strike price. That might be a consideration. Now, this is a strategy that you use for bullish and neutral market conditions, or neutral to bullish stock positions, what they're doing, what they're trending like. It's not necessarily a strategy for if a stock is downward trending. Okay, some people think, well, my stock's going down now and I'll just sell calls against it. And if somebody's in a very long-term holding position, that could help. But when you're selling calls, cannot necessarily completely take away whatever is happening to your base on your stock as it's kind of sliding and pulling back. Now, your maximum reward, you have to keep in mind, is capped at the strike price. Now, when we go through some examples, this hopefully will make more sense to you. Okay, what are some of the benefits and risks? Because every strategy is going to have them, right? So one of the benefits is just generating a little bit of option premium income into your account. When we sell the call, that credit goes in your account immediately. You don't have to wait to the end of the trade in order to be collecting that premium. It creates a little bit of a protection for you up to the premium that you collect. So as we look at some stocks and some charts, talk through some numbers, you'll see that. It is often used in short to intermediate time frame trades. That's when people might use it. You don't have to think of it as just something very longer term in your portfolio. Now, risks, what could those be? Well, we're going to limit our upside potential, meaning if the stock were to appreciate to a point and it goes beyond our strike price that we've sold, we don't get to capitalize on that. Now, we capitalize on the growth from when we bought the stock to where we might get called out. So we get that growth, but anything beyond that strike, we would not benefit from. So we just have to realize that. Shares could be assigned at any time prior to options expiration. They could create capital gains or capital losses when that occurs. And so you just want to know, it's not just when the option gets to expiration, if it's in the money that we might be assigned on it. It could happen anytime from the moment we hit sell out in our paper money platform. That's a potential obligation. And that downside is protected just to the premium that we received. Now, the idea of selling a call against your stock is a little bit like the idea of putting a for sale sign out in front of your house. Okay? If you put a for sale sign out in front of your house and say, yeah, I'm willing to sell it, we have to be willing to sell it. And so if you have a stock that you are married to and you dearly love and you'd be really upset if you lost that stock, you might not want to sell a call against it. However, you might want to be a little bit more flexible in your perception of how long you might want to hold on to a stock. You want to be aware of upcoming events like earnings, or if a dividend might be paid, because that could have some potential ramifications for you if the stock may be moving really big, going beyond your strike price. You want to consider volatility, and notice that when a stock is more volatile, typically it's going to generate a bigger premium. Okay, a stock that's not wiggling around a lot might not generate as much premium as a stock that maybe is having more vacillations in its price and the volatility, maybe moving that stock around. You want to be alert to tax implications if you are called out and you do indeed sell your stock. So if you're in a tax preferred account, or not preferred, a tax deferred account versus a cash account, those could have different implications depending on what kind of an account you're working with. Now, what kind of stocks would we consider doing this on? All right, we're going to consider doing this on stocks that are maybe getting a little bit neutral, maybe being a little bit sideways. Maybe they have come up, they've hit some resistance, and they're just not going it much further than that. Okay, maybe they look like they're ready to pull back, or maybe they have pulled back a little bit. So we're talking about on the chart. What are we going to be looking for there? Now, some of you are familiar with the close below the low of the high day. So that means, a stock's in an uptrend, it starts to pull back, and then we'll be looking for, do we have a close below the low point of the high candle? We'll look at that when we get to some charts. Now, we'll always want to do it with stocks that have higher trading volumes. All right. So typically that's going to mean liquidity, easy to get into, easy to get out of. And then when we're working with those options, same thing there, right? We're able to get in and out because they have higher open interest or higher volume. And then that typically leads us to stocks that have tight bid-ask spreads, right? So there's not a big difference in the price between what the bid price is and the ask price. That makes it easier for us. Oops, something just got filled. That makes it easier for us as traders. All right. Let's see here. Let's go to Thinkorswim. All right. We're going to go out. Take a look here at what we might be talking about here. Now, I have over in my gadget area, I have some Dow Jones stocks here. We're just going to look at some of them. Whoops, we're not going to draw yellow on them though. We're going to look at some of them and talk about, would this particular stock, based on what we talked about, timing-wise, be good to sell a covered call? Now, it's been about 3 weeks ago, I taught a class in here about covered calls, but it was called the buy right strategy, where you buy the stock and sell the call at the same time. And what we're talking about here today is that we already own the stock, and then later on we're thinking of selling the call, and that's called a legging in strategy, which all that means is we're doing it at a different time. We're selling that call at a different time than when we bought the stock. Maybe we bought the stock last year. Maybe we bought the stock last week. Doesn't necessarily matter when we bought the stock. It's just the idea that we already own the shares, so we could deliver them to somebody else if indeed we receive assignment on this call that we sell. So yeah, we need to be willing to do that, just like Eva said. All right, there. So let's take a look here at, I'm going to pull up CVX. Now I've got just a 5-month or a 6-month chart up here, so we can just kind of see that intermediate to short-term time frame. So I've got a 10-period moving average on here. That's the blue one. Got a red 30-day moving averages. So those give us an idea what's the short-term trend doing, what's the intermediate trend doing. I also have on here a MACD study. For those of you maybe that are not familiar with this, let me just show you how we grab it and what it means, why you might want to use it. So just you start typing in here MACD. Now MACD is a short acronym for moving average convergence divergence. Okay, MACD is pretty good. We don't have to say that whole mouthful. But essentially what it's trying to measure is momentum shifting. Momentum shifting as the price of the stock maybe is moving up, or if the price of the stock is pulling back. So I grabbed the histogram. There's a lot of ways that you can see a MACD. I think the histogram is really easy to see what's going on, see what it's trying to tell us. We don't have to try to figure out the crossing moving averages because there's actually 3 in that study. And so as we look at the MACD, those of you that maybe aren't as familiar with it, when it is above this 0 line, it turns green. And when the momentum is building, it kind of is this fluorescent Kermit green. And when the momentum is slowing down, then we see it kind of turn to this darker forest green. Can you see the difference here? We've got Kermit green here, and then more like forest green here. So when it turns to forest green, it's telling us, well, the momentum isn't quite as high as it was. It's still above 0, but it's just not as high as maybe it was initially. And when you see the dark green come on, this is what we call a rolling over. We might call it, the MACD is rolling over, okay? When it's down here below 0, it creates these red bars. And the bright red means the momentum is stronger to the downside. And then when it turns this kind of this darker red color and the bars get a little bit shorter and a little bit shorter and it's coming up towards this 0 line, that gives us the idea that, oh, okay, the momentum's swinging direction. And then some traders will look for it to cross 0, or if they're helping it with their entry skills of certain things, they might get in a little bit early in a buying scenario. But for a selling scenario and selling a covered call, what might be helpful here on the MACD is maybe to see it as it peaks and starts to roll over. Okay, so peaks, starts to roll over. When it starts this rollover, that might be good timing to sell the call. So in this case, we're looking at Chevron, right? Chevron has been kind of sideways trending for a little bit of time. Somebody might still be holding on to it, okay, or maybe they just purchased it recently. And today, what's it doing? It's breaking through resistance. And this MACD line is surging. Can you say that, Forest Green or Kermit Green? It's just kind of surging. That lets us know that it's really having some good momentum. Some people might like that to buy the stock, right? They might see a breakout type entry. And so on this would go, no, that probably is not the best time to sell a call against something you already know. Oh, okay, we want to maybe have it come up higher, hit some resistance, and then we'll go, okay, maybe that might be good for us. Okay. Rosa says, how did you get the MACD histogram again? Come up here to your studies, that little beaker or flask, select on it, come over here to your studies and start typing MAC. You don't even have to type D, and we start seeing the different MACDs. The one that I chose here is the histogram. Okay, I think it's just the easiest ones for your eyes to identify. Okay, what's it doing? Helpful to be able to see that. All right. Now let's see. So that CVX maybe not good right now. What else is another stock here on the Dow Jones? Let's look at CRM, Salesforce. And we've got Salesforce.com. What's it been doing? Well, the 30-day lets us know it's been trending down for a bit, but maybe starting to get a little bit of momentum. In fact, the 10-period moving average was starting to run up. So we're starting to see a shift of trend here. Had been downward trending, maybe now it's upward trending. Now, I'm just going to zoom in here and see what we're seeing. The MACD is rolling up. Now, I realize the price of the stock is down a little bit so far today. We're getting a red candle there. So it might be starting to shift, but generally when we're seeing these redder bars roll up and price rolling up, it might be a good time possibly to just be watching for the rollover, watching to see when the weakness moves in. It might be starting to come in when you see it with this price action, maybe hitting the moving average, starting to pull back. So some people might consider selling it there. I'm going to say it's not an absolute, oh yeah, that's absolutely the best time. It's kind of in between. Watch it, see if you get more confirmation that maybe it's going to stay on the downside, because right now it looks like the momentum is shifting the other direction. Let's look at Nike. Nike here. Same thing here. It had been downward trending. And it's like right now, is it gaining momentum? Yeah, it kind of is. I know it hasn't been upward trending a real long time. It looks like it might be. Now, earlier today, it looked like it was breaking through this resistance. Okay, this might be one where you're like, okay, I'm not sure if it's really breaking out here or if it's using this resistance to maybe roll over. So if somebody on Nike, they might go, it's at resistance. I might consider selling a call against it, but somebody else could say, I'm going to wait for confirmation. We see the MACD is above the zero line, but it's not as high as it was, say, back here. Right back here, we can see there's a lot of bullish momentum. Here, it's above zero, but it's not really strong momentum. And so if we were to see, say, this MACD or the price pull back against the resistance, maybe hit its head on it like these other days have been, and then we see what's left of the MACD here kind of shrink and maybe go to the downside, turn red, that might be a time that we would sell a call. Now, the ones we're going to look at are going to be a little bit more concrete, but I wanted to have you say, if you think it's time to sell one or not. Okay, so we're going to look at one more, and I want you to ask yourself the question, would this timing-wise be a good candidate? Now, Andy here says, hey, we've got Nike earnings coming up. Let's see when that'd be. Last earnings looks like it was on March 20th. So let's go like this. Yeah, make sure we see the earnings dates here. Okay, so what you're catching on to there, Andy, is, hey, pay attention to events coming up. It already paid a dividend, so that's not going to be a factor. But maybe going into earnings might be, especially if earnings were a lot closer. Now, earnings here look like they're going to be on the 26th of June. So that's about in 16 days, so a couple of weeks. So we want to be aware of that. However, because it's not like knocking on the door, earnings maybe being this week, some people might not be as concerned about it, but I like your awareness there, Andy, on that completely. All right, let's look at this other one. All right, and I want you to answer to yourself, is this one look like it has good timing to sell a call? Now this one's a little bit busier because I've got Amgen, or I've got a Fibonacci here on Amgen looking at. And so looking at this Fibonacci, you may or may not know, because this is something that gets into kind of using some advanced studies. And a Fibonacci, basically, if we see a line here, it's interesting. It looks like the stock might be using this 50% level of the Fibonacci kind of as resistance. See how it ran up to it, rolled down, ran up to it, rolled down, ran up to it. It's having a hard time getting over it here, but today's got a kind of a strong candle. The candle's holding strong, and what is the MACD doing? The MACD is surging here. So somebody might say, you know, maybe not right now. If this price continues to surge, let's maybe wait for it to run up and roll over again on that MACD, maybe hit some different resistance, if indeed it pushes through that 50% level. Now, it's not guaranteed that it will, so it'll be something, might be interesting to wait, see what it does. Now, let's look at something that I think maybe has a little bit better timing. Okay, so I'm going to pull up Cisco here. This is a 6-month chart, you can see. And up here around 66, it has been 66.5 has been a strong resistance area, right? It's run up to it, pulled back, ran up to it again, pulled back. Notice when it pulls back, that's when that MACD kind of rolls over a little bit, right? Goes from the permit green to forest green, right? So that bullish momentum is starting to kind of drain off, start to weaken. And so what has it done? It's run up here again. The MACD didn't get nearly as high as it did the previous time, right? Previous time, man, that momentum was really strong. And right now, man, those bars didn't run up very far. So number one, that tells us the bullish momentum there isn't as strong as what it had been, okay? And it's at resistance. And then what's it done in the last couple of days? Looks like it's maybe pulling back a little bit. So how did you answer the question? How did you answer the question, does this look like it might be a good time to sell a call on Cisco? Okay, takes a moment for you to hear what I say and for you to respond. Okay, so I'm going to give you a moment to do that, but want to get your feedback on that. Does that one look like maybe it's in a little bit better position or not? Okay, I'm going to say, you guys you've already answered me, but I'm going to say, yeah, that might be a little bit more like what we're looking for. Some of the ones were too early because they were building momentum. Others, you know, they weren't really telling us if we weren't sure if they were pulling back yet. We said in the slides, you know, maybe looking for a close below the low of the high day. So the high day is running up here. Let's see where the high day was. Looks like technically yesterday was the highest day, and then its closing price was $65.90. Right now, the market isn't closed, but if the market were to close right now, yeah, it would be meeting that condition, a close below the low of the high day if we have the closing right now. Now, it's not guaranteed it's going to be there, okay, but it's looking like it has that possibility. All right, let's go to our next step. One, we've identified a stock. This guy has a good trading volume, by the way. I was using stocks on the Dow Jones as examples to look at because I know, man, they have thousands of contracts and thousands of shares being traded most days. Let's go to the trade tab here. And let's kind of bring up what some of our possibilities are. So we've got the timing. We're going to say, okay, yeah, might be good timing for this. I have to tell you, you guys, I'm not sure if I'm getting all of your messages because it kind of stalled and stopped on me. So I hope I'm getting in all your messages. If not, Scott's going to have to be working overtime answering the questions that you've got for me. All right. Okay, we've got a whole option chain to choose from. Man, how do you decide how much time we want to sell? Okay, there's a window that many traders might like to use. That window is maybe 20 to 40 days worth of time. Sometime we might have to go out to 50, go out a little bit longer, depending on what options we have available for us to sell. So we have options that expire this Friday. So probably pretty short time frame. We wouldn't be interested in that. Or even the 10 days in most circumstances as you're learning the strategy. We want to be able to sell some premium here. So we might say, well, 23 days fits the 20 to 40 day window. So does 31. So does 38. And then, so we probably have plenty of choices without maybe necessarily needing to go to the 45. So let's look here in the July 3s, first of all, and expand that. Bring, oops, wrong one. Let's get the one I wanted, July 3rd. There we go. All right. This column that I'm pointing to right here is my open interest. Cisco today's traded so far 4.8 million plus shares. Okay, so that's some good trading activity there, first part of the day. This column here is my open interest. And so do we have many choices here? Well, we have, let's look at deltas now. Typically, if you're just looking for a range to sell, maybe high 20s to low 40s delta, which means kind of a target area might be in the 30s that some traders like to use. Okay. Now, if somebody really wants to be called out, they might consider selling something in the money. Okay. Like say the 65, it's already in the money. So maybe there's a possibility that they might be called out because it's already starting out in the money. But we would say maybe something like this, the 67. Now, it has 98 contracts there. If somebody's trading a lot of contracts, say you have like, you want to sell 10 contracts because you've got 1,000 shares. This might not be, you might say, I want a few more contracts out there. So let's see what else we could look at. Let's open up the 11s. Let's see if the 11s expiration with 31 days gives us more. Well, we come out here to our 30-something delta, and it's about the same, 93. So it's not like as many contracts as you might feel comfortable with. Now, if you are somebody that's just trading one contract, then you might be okay. We just typically don't want to be more than 2 to 5% of the open interest, right? We want there to be lots of contracts exchanging out there. Now, as we go here to the July 18s, has 38 days, now we're starting to see thousands of open interest. This happens to be our volume column, so we can see what's going on today, but really a focus here. We're like, okay, yeah, that's a lot better than 90 contracts. We've got 10,000 contracts here. We've got 13,000 contracts here at the 31 delta. So we're going to go with this one. Okay, we're going to go with the 31 delta. Notice the spread here. 65 cents by 63 cents, 63 by 65, just a difference of 2 pennies. Oh, we love to see that as traders. We love to see that narrow bid-ask spread because then the stock doesn't have to do so much in order to put us in a more positive position. Sharon says, is it a good time to sell a call on Microsoft? Well, we're not looking at Microsoft yet. In fact, I didn't have a plan. But I want you to look at it, Sharon, and tell me, based on what we've talked about so far, if you think it's ready. Do you think it's good timing? Are you seeing the run up and maybe a halt, a resistance, or maybe even a rolling over? Timing-wise, that's kind of what we're trying to look for. Now, earlier today, because I didn't have 100 shares of Cisco in my account, now I do. Okay, now I have 100 shares of Cisco. And since we already own the stock, and again, you could have bought it last week, last month, last year, it doesn't matter when you bought it. We're going to go ahead, we're going to sell this 67.50 contract, and we're going to be able to bring in some premium of 63 bucks. Okay. Now, that's not a huge amount of money, 63, but could this generate a little bit of income for us in a scenario where we don't have to go buy more shares of the stock, right? We are just going to say, hey, we'll let you call us out if that happens, right? We're willing to let you buy our stock away. Now, let's go look at the chart in relationship to 67.50. Okay, come out here, and I'm going to kind of zoom out here a little bit. Where is 67.50? I'm going to put a line here. And so I'm going to go up here, 67.50. Woo, it's about right there. I am so close. All right, we'll take the 67.52, but that's generally pretty close to where that strike price is. So we would still get the growth of the stock from whatever I paid for it this morning or last week or last year when you bought it, okay, up to 67.50. Okay, we would get the growth of that stock if it were to continue to go up to there. Great, we get it. But say Cisco has some breaking news. Say Cisco comes out and they say something that is wonderful, and that stock starts taking off again. Okay, it might run through resistance here, and it might run past our 67.50. Should we be upset about that? Should we be concerned? Not really. Okay, because we already received some premium. We received that $63 into our account already. Plus we get that additional growth of the stock. Now, many times it'll come out, say if it was called away from us, it was assigned and we had to sell our stock, we're okay. Could we buy the stock again? Sure we could. Could we maybe do it at a price point that we're happy with, right? For entry signals that we like? Absolutely. So sometimes people get a little stressed out about, oh, it's going to take away my stock. We're already prepared for that. When we got into the trade, we already knew that. We were good with it, which is why we did that strategy. Now, some people can be really active with this strategy, okay? They might sell like what we're going to do, and that's going to have, 38 days left till options expiration. Some people might, for example, let's suppose the stock does this. Let's suppose the stock kind of goes down and down and down. What's going to happen to the price of that 63 cents? What's going to happen to the value of that put? Okay, if the price of the stock, I said put, I meant call. The price of the call where we sold it at 63 cents, if the stock pulls back, it's going to get lower and lower. What if it gets down here so it's worth maybe say 15 cents? Maybe somebody would consider buying it back. They'd go 63 cents, buy it back for 15 cents. Gee, I make a net of 42 cents, 43 cents. Okay, and might approach it that way. If it looks like maybe the stock is gaining strength, maybe it's coming down here, it's starting to bounce. Maybe you notice, maybe say it comes down here to a support level, then you might go, I could go buy that call back really cheap. And then my obligation is over. I don't have a call sitting out there that I've sold because I just went and bought it back. And so then you go, okay, well, let's let our stock run up some more, maybe find some resistance and roll over, sell it again. Okay, so that's why I say some traders might be fairly active with this strategy. You don't have to be, but if you want to be, it certainly is an opportunity. All right, let's come in here and just go through what we would do. We picked the option. We picked that 67.50 for, and now it's down to 62 cents. It's okay, 62, 63 cents. On your default, if you have not changed it, it might come in here with 10 contracts. I've changed my default to go to just do one contract. So you might want to do that. How would you do that? Come up here to your setup. Come over here to application settings. Come over here to order defaults tab. See that right in the middle? Order defaults. So on my stock, I have it doing one contract. And let's hit on options here. So my quantity default here is 1. The default, when you open up your Thinkorswim the first time, it's set at 10. So that's why I say you might need to change it. And then I have it incrementing by 1 as well. Okay, these are just practice trades. They're out in our practice account or paper money. So we're trying to get the idea of the strategy. So we're good just selling one contract. All right. So that's how we would do. We click on that ticker symbol, right? Let me collapse that. We come down here, we click on the bid price. Let's change it a little bit here, 62, 63 cents. We better sell it. We're going to go here. We're going to hit confirm and sell, and then we're just going to send it on its way. Should get filled on it. Oh, good. It filled it at 62 cents. So that came into our account right now. That's $62. Boop. It's in our account. Where can you see it? If you're like, well, I want to see it. Okay, where you can see it, go to your monitor tab and then go to activity and position. Oh, actually, account statement. And then this will show you like every little transaction that's going through this cash and sweep vehicle. And mine has the most recent stuff on the bottom. So I'm going to have to scroll down here. So 610, that's today. That's a vertical that we bought. Where's our call that we just sold? Oh, it didn't post yet. Okay, it'll post out there. You can see it, but you can see in your filled orders, you can see that this was the last one filled, our Cisco for 62 cents. All right. Would you like to see another example? Let's do another one here. Let's see here. There's something that maybe Scott is helping you guys out with there about that you could be assigned anytime, right? Once we put the for sale sign out there, yep, somebody can buy it. Somebody can exercise their right to a call that they bought, right? And exercise it for whatever that strike price is. Okay, let's look at another one here. Let's go to our chart and see this one. Oh, actually, let's do this one. Oh, we've got a stock in an uptrend. What do you think about timing wise here? Does this look like one that has good timing? Okay, ask yourself that question, answer to the dog or your computer screen. Okay, we've got a stock that's been upward trending. Now we're not seeing resistance here, but what has the stock done? It's run up, and what's it doing? It's rolling down. What are we seeing on our MACD? Well, the MACD didn't rally nearly as high as it did back here. So the momentum wasn't nearly as strong. That gives us an idea that maybe momentum is slowing down a little bit. Okay. Let's go look for a close below the low of the high day. Let's go look for that entry signal. Let's zoom in here. Our high day here, it's even pointing it out for us, 257.47. And then let's see yesterday. Let's see its low price. Its low price yesterday was 252.07. So to get a close below the low of the high day, we'd want to see it close lower than, where did it go? 252.07. That's the low. And then here, did it close below 257? It closed at 251. Okay, so technically yesterday we got our close below the low of the high day, and it's continuing on. Would probably call this confirmation. We see it's on the zero side on the MACD, so it means the momentum is more negative, and we're seeing that just kind of reflected in the price of the stock. Okay, so let's see. What did you guys say? Did you say maybe it might be an okay time for it? I would say either yesterday or today is good timing for that. Okay, where do we think it could drop to? I mean, we don't always know where it's going to drop to, right? If we did, man, that would be pretty cool. Let's go out here to a 1 year chart. Looks like it's at its 1 year highs right now. This run, I think, is putting GE at an all-time high here. But where would we say there is some support? Actually, let me zoom in here, because there was some old resistance here about 213, but that's a ways down there, right? To go to 213, let's see, that was old resistance, so it should act as new support. Probably the most recent support, although it's short term, is right here near this bounce at the 10-day. So we might say, okay, this might start acting as support. It's only bounced there once. Would want to see it bounce. Would like to see it bounce and have more touches off it to know that it is a strong support area. So we don't know how strong it is, but it could pull back that low. Doesn't mean it will, right? But support and resistance many times will do their job of creating areas of enforcement where a stock bounces to either to the downside or to the upside. All right, let's go look here. Let's look at GE. Now, this is a more expensive stock more recently, right? It was down here about 180, and it just had this big run the last few months. And so it's kind of a hefty price right now. So if you had 100 shares sitting in your account, you could consider doing this. What are the choices here? Well, let's see. It's traded over 5 million shares today. So again, another good active trader. We've got several choices in terms of time, right? We've got 23, 31, 38. On this one, let's just go, well, let's look at July 11 and just see what we've got out here. Not a ton of open interest, right? 19, 22, 121. Yeah, so not a lot there. So we're just going to go out to the July options. Typically, they're going to have a lot there. And what strike price corresponds mostly to a high 20-something delta or a low 40-something delta? Got a couple of choices here. There's not a 30-something delta. So we might say 250. We could sell 250. That gives the stock $8 and a few cents to continue to run up before it gets to our strike price. If you were somebody that wanted to go maybe a little further out, give yourself more space, 60, you could sell the 260. Both of these are bringing in a really, I'm going to say, decent premium. We've got both of them have lots of open interest. You shouldn't have concerns if if you're selling 20 contracts or 10 contracts. There's oodles out here. All right. And the bid-ask spread isn't too bad. Okay. 15 cents here. This one has been waffling between 15 and 20 cents. We're going to go with the 27 delta. Okay. We're going to go ahead, and all we're going to do is we're going to click on the bid price there. It's going to queue it up. We already have 100 shares sitting in our account. Now, what if you didn't have 100 shares sitting in your account? Well, it wouldn't be covered, meaning you wouldn't have the ability to take the stock from your inventory to cover your obligation. But because we do have the stock in our account, that's why it's considered covered, right? Brokers look at it as a more of a lower risk trade because you have the shares sitting there. But if you didn't have the shares sitting here, yeah, that would be a much more aggressive strategy with potentially unlimited loss potential. Okay, so that's why it's so important we have at least 100 shares of the stock. All right, now I want to point out a couple of things to you. Now, number one, I hope you've already become a subscriber. I'm just going to send this on to our Trade Talks channel. That's where it makes it easy to find our content. I wanted to point a couple things out to you here today as we jump over here. When you become a subscriber, it just makes it really easy to find our content, okay? You can see our playlist, what we've got going on. You can come back over here to the home, see maybe what's happening, what's coming up next. So coming up next is going to be Brent Moores with long options. He's going to start at the top of the hour, and you can see our lineup for the rest of the day. Okay, or you can look at our playlist. Now, what I was going to point out to you, we have a new class, especially for those that are super new. Okay, it's stock investing for beginners, and our own Scott Thompson taught the class yesterday. All right, so if you're maybe somebody that's like, yeah, I really need to get stronger on my stocks type thing, that might be a webcast that you might want to consider joining. Now, if you're somebody that feels a little bit more experienced with some things and you're ready to start learning these option strategies, and you're thinking, I think covered calls could be something I could be interested in. Come down here, 7 rows, 1, 2, 3, 4, 5, 6, 7 rows. And then come over here. Cameron actually teaches a class on Mondays, covered calls and short puts. They're very similar strategies. So he'll focus on those only in that class. And I believe that is on Monday as well. All right. If you weren't sure, you can come up here to the post, and we've got that calendar posted for you right now. So you could come in here, and you could come down here and, look at that, at 2 o'clock Eastern time. That's when Cameron teaches the class on covered calls. All right. So be a subscriber. If you found this helpful today, go ahead and hit the like button on your way out. Appreciate your attention. What can you do if you want to get better at understanding covered calls? What can you do? you can paper trade, okay? You certainly can paper trade. I wanted to come to the summary slide here. Because that's how we learn the strategies, by practicing it out in paper money. Don't be afraid to practice in your paper account. That's where we want to practice, okay? So I'm going to encourage you to do that. You know, over the next 2 weeks, see if you can get on 5 covered call trades that you can watch. Look for the right time to sell the call against it, just like we did in this legging in approach. All right. Scott, thank you so much for your help in the chat. Appreciate it. Appreciate all your participation here today. I didn't see a survey. Okay, so you're off the hook that way. But let us know if this was helpful to you, hitting the like button. We'll see you at the top of the hour, long calls. I'll actually be in the chat in that session, so we'll see you then. Bye-bye.